Equity prices recovered from an overnight sell-off that pushed us to new lows of this move since the most recent trade above 2,800. And it wasn't a big move lower, but it certainly showed that the market is a little bit sketchy, or at least not on solid ground right now, as we are still hovering at that key 2,800 level in the E-mini S&Ps. Recall, we made the move through the 200-day moving average, which is around 2,750, and it has been for going back over the last 5 or 6 months. In October, we traded through 2,750, hit 2,800, and reversed. We did the same thing in November, and we did the same thing in December, and now we've done it in February, and it seems to me that the market is waiting for that downtick back down to 2,750 at least or beyond for any major buyers to come in. And from a technical standpoint, we are hovering sideways now at 2,800, which I think is more bullish, given the fact that over the last quarter and a half, we've seen this trade before, and it's not mimicking what we saw back in Q4. So right now, we are still gravitating back to that 2,800 level. I think that's positive for equities, at least today, after all the news we saw. And if you look at the VIX index, it was opened up this morning on a spike, given what the tensions that are rising between India and Pakistan. Likewise, the uncertainties in Washington and China and trade, and some of the things that we continue to talk about. And the VIX index actually came back down as equities rallied at least back to the 2,800 level or just below it. So right now, with the equity markets sort of not making any quick, sharp moves, we are seeing the volatility index reflect that. So a spike this morning, and then it gradually came lower and looks to settle on the lows of the session. So right now, stagnating prices, lower volatility, and I think that right now the near term is really the concern. Near term uncertainty is starting to take precedent over long-term growth and long-term outlook. And when I talk about near-term uncertainty, obviously the previously mentioned tensions going on between India and Pakistan. You've got economic weakness here today. You have factory orders and home data that is looking very poor. We had a Fed chair that really didn't talk about an expanding economy, didn't talk about the Fed raising rates, didn't talk about the Fed aggressively unwinding its balance sheet. It was more about holding the status quo and being data dependent. And I think that right now, with Brexit on the horizon, we've got a March FOMC meeting coming up just before that. It's going to be very critical for the Fed to how they play this, and equities will watch the Fed. And the Fed right now seems like they're going to play ball, and they're not going to act quickly, and they don't want to be hiking rates, and they don't want to be tightening the environment if there's going to be trouble. And I think that Brexit remains that catalyst event that could cause that trouble, or the ripples that could come from a hard Brexit. So right now, the equity market's still hovering at 2,800. That is moderately bullish, but don't forget, the last 3 times we made this trade, we pulled back significantly. We haven't seen that yet, but if we get a weak GDP number tomorrow, followed by any sort of distress from the Fed, we could be seeing lower prices before too long.